Hi there, very good morning. Welcome back to ET. Now you're watching Market Café with me, Kanishka Sarkar and Snehisha. And before we get started with all the global and domestic cues that we need to watch out for, wishing our viewers a very, very happy Diwali and a very happy Diwali to you and your family too,
Happy
Snehi.
Diwali, Kanishka. Absolutely. And look at our studio, we're decked up.
Absolutely.
We're all ready for
all
Diwali.
Set for Diwali. Well, before we, start the festivities, let's take an eye on how the US markets fared last week. The US markets wrapped up last week on a very positive note. Despite the volatility that we saw during the week, the Dow Jones Industrial Average that gained about 238 points, or about 0.5%, while the S&P 500 that also advanced about 0.5%. The Nasdaq Composite, the tech-heavy Nasdaq Composite, that also saw gains of about 0.5% on Friday. In fact, all the three major indexes, they ended the week higher. The S&P 500 up about 1.7%, the Dow gained 1.6%, whereas the Nasdaq, that outperformed with gains of more than 2% on a weekly basis. That was supported by a solid start to the third quarter earnings season. In fact, the market rebounded after a sharp midweek sell-off that was triggered by concerns over bad loans at regional banks. Stocks like Zion and Western Alliance, they recovered on Friday, easing some of those credit jitters. Sentiment also got a lift after reports that Donald Trump is moving to exempt dozens of products from tariffs, signaling a softer stance towards China. U.S. Treasury Secretary Scott Bessent, he added that talks with Beijing appear to be de-escalating, fueling optimism ahead of Trump's expected meeting with the Chinese president. Now, the CBOE Volatility Index, that is VIX, that spiked above 28 during the week. So yes, that's there. But now looking ahead, earnings season takes the center stage. Big names like Netflix, Coca-Cola, Tesla and Intel, they're all set to report results this week. On the macro front, all eyes are going to be on Friday's Consumer Price Index that's expected to show inflation still running hot data that could influence the Federal Reserve's next rate decision later this month. Meanwhile, the US government shutdown that has entered its fourth week, keeping a lid on broader investor confidence. So that's how the US markets fared last week, Snehi. But how are things on the crude front?
Happening if you take a look at what's happening with crude. Oil prices were little changed on Friday but posted a weekly loss of more than 2% after the IEA forecast a growing glut, and US President Donald Trump and remember Russia's Putin, they've also agreed to meet again to discuss the entire Ukraine conflict. Trump and Putin agreed on Thursday to another summit on the war in Ukraine to be held in the next 2 weeks in Hungary. Now this planned summit comes on the top of the ceasefire agreement ending, at least temporarily, the fighting in Gaza between Israel and Hamas. The development in the Ukraine war came as President Zelensky of Ukraine and Trump met at the White House on Friday to push for more military support, including US-made long-range Tomahawk missiles, while Washington pressured India and China to stop buying Russian oil. So lots is happening on the oil front. Let me tell you what's happening with the oil counters. You have WTI at 57.4 thereabouts, a sharp knock coming in, and the third weekly loss coming in for WTI oil. You also have Brent around 61. It looks like it could slip below or at least come around that 60 mark because a 0.3% cut is something that we've seen on the Brent over the weekend as well. But while that was oil, not everything is looking good for the precious metals as well, because gold prices fell more than 2% on Friday after hitting a record high above that $4,300 per ounce, pressured by a firmer dollar and US President Donald Trump's comment that a full-scale tariff on China could be unsustainable. So spot gold was down 2.5%, around 4,211 per ounce after scaling to an all-time high of 4,379 almost earlier in the session. And it's not only gold that's under pressure, you have silver also that's fallen 4% from its all-time high. Seems to have recovered a bit because it's above $50 right now. But let's see what happens to all of these precious metals. And yes, that is everything that's been happening on the commodity front, oil as well as precious metals. Kanishka.
Absolutely. So those are some of the cues that we're tracking on the global front. But let's also take stock of some of the global news that we have got over the weekend. Now, in a tense meeting, US President Donald Trump, like you mentioned, has reportedly urged Ukraine's Volodymyr Zelensky to surrender territory to Russia in exchange for peace, which is a proposal that left the Ukrainian side frustrated. Trump also refused to supply Tomahawk missiles and floated vague security guarantees for both Kyiv and Moscow, which has even confused Ukrainian officials. Now, he later called for a ceasefire along current front lines, a shift seen as pressuring Kyiv toward a deal after a recent call with Vladimir Putin. Sumita Kareer, my colleague, is now here to take us through all the details. Sumita, over to you.
So this definitely is an important development that has happened at the White House once again, with the US President Donald Trump meeting Ukrainian President Volodymyr Zelensky to further and to discuss talks on how to bring about peace as far as Russia-Ukraine war is concerned. In fact, a key topic of discussion was Ukraine's request for United States long-range Tomahawk missiles, and that is something that Ukraine feels could force it to strike deep into the Russian territory. And of course, Zelensky feels that this is something that would stop Putin from continuing with the war. Now, that is something that, is if Donald Trump is not very keen on as far as these Tomahawk missiles are concerned. And of course, in recent days, we've also seen after that lengthy 2-hour discussion with President Putin, President Donald Trump has softened his stance as well. He said that, both sides should now come on the negotiating table and both sides should essentially look at ending the war in Ukraine. But more importantly, speaking about ending the war in Ukraine, a significant development is coming from Donald Trump, and that concerns India and, of course, Russia. He has said that he has been assured that India is pulling back from buying Russian oil. He's also said that India is not going to buy Russian oil and that India has de-escalated on buying it, and that India bought about 38% of Russian oil is essentially what Donald Trump stated. Now, that is a claim, that India has not been very comfortable with. And we did hear from the Ministry of External Affairs, the MEA said that they are not aware of any Trump-Modi conversation that has happened. The MEA also earlier stated that India's policies of buying oil, they are completely guarded by safeguarding consumer interest and volatility, even though India has increased its energy procurement from the United States. The US administration has shown interest in energy purchases from India.
I met with President Zelensky, as you know, today, and we had a very good meeting, very cordial meeting. In my opinion, they should stop the war immediately. You go by the battle line wherever it is, otherwise it's too complicated. You'll never be able to figure it out. You stop at the battle line, and both sides should go home, go to their families, stop the killing, and that should be it. Stop right now at the battle line.
Okay, that's the word coming in from Donald Trump that's got global markets in a jiffy. But meanwhile, Ukrainian drones struck Russia's massive Orenburg gas processing plant near the Kazakh border, igniting a fire and halting gas intake from Kazakhstan. This is what officials have said. The facility, operated by Gazprom, is amongst the world's largest, handling 45 billion cubic meters of gas annually. The Kazakh Energy Ministry confirmed a temporary suspension of processing due to the attack. And Israel said a ceasefire in Gaza has resumed after airstrikes killed 26 people. Aid deliveries into Gaza are set to restart on Monday under US pressure after Israel briefly halted them, accusing Hamas of violating the truce. The strikes targeted Hamas positions but also hit a former school sheltering civilians. This is what residents have said. Tensions remain high amid disputes over the return of hostages' bodies and fears the fragile ceasefire could collapse again.
Moving on, large crowds rallied across US cities over the weekend for No Kings protest, denouncing what they call Trump's growing authoritarianism. The administration, however, mocked the rallies with a video showing Trump as a crowned monarch. While Republicans dismissed the event as hate America gatherings, protesters described them as patriotic acts defending democracy amid a deepening government shutdown. Moving on, in a daring daylight heist, masked thieves used a crane to smash into Paris's Louvre Museum on Sunday, stealing priceless jewels from the gallery that houses France's crown treasures. The robbers struck minutes after opening, completing the theft in under 7 minutes before escaping on motorbikes. Officials say 8 of 9 targeted items were taken, including Empress Eugenie's crown, worth tens of millions. Next up, luxury group Kering will sell its beauty division to L'Oreal for €4 billion in a deal aimed at cutting debt and refocusing on fashion. The sale includes fragrance house Creed and 50-year-old exclusive licenses for Gucci, Bottega Veneta and Balenciaga beauty lines. Now, under the new Deal carrying is streamlining operations after weak luxury demand, particularly in China. That was where Gucci sales have taken a hit.
Okay, well, on that note, we'll slip into a very short break. That was a wrap on all our global coverage this morning. But on the other side of the break, we'll tell you how the Asian markets have opened up this morning. So you stay tuned.
That we have coming in. Now, consumption, that's been the biggest theme this year. Now, Finance Minister Nirmala Sitharaman said that India's consumption story will continue even if change in patterns will take some time. Let's take a look at what she had to say.
Tax reductions are required from the point of view of making the system a lot more nimble. Better collections means you have greater room, fiscal room to give back something. So now that the collections are improved and steadily we are touching almost close to 2 lakh crore gross collection per month, there is a reason for us to cut the rate also and give the benefit, pass on the benefit to the consumers. And all these items are mostly day-to-day items. Yes, you won't buy your car every year. But the fact remains, for that person who goes and buys it, it may be a lifetime's purchase. He gets a better rate. If the consumption basket itself took some time, I would think a long time, unduly long time. The pattern on the consumption shift because of the reduction in GST will take a bit of a time for us to come back to.
Okay, and let's also go across and listen into Commerce Minister Piyush Goyal and his take on this entire GST cut and what he had to say about it.
India is resilient. India has clarity in its vision. And India continues to purchase goods and enjoy the fruits of services, even after the announcement on 15th August. The growth trend continued in the rest of the August month. In August, the outward FPI was about $4 billion. As soon as the GST announcement came in, people quickly, investors are sharp, they can see the future. They quickly realize that this is a bonanza, and Indian business, Indian industry, Indian growth story, Indian demand of goods and services is surely going to see a massive upswing. And therefore, in the month of September, the outward FPI fell straight away from 4 billion to less than 900 million.
All right, so that was Piyush Goyal's comments on GST and India's consumption story, but he's also reiterated that India-US trade talks are moving in a cordial manner and that a deal will not be inked on the basis of a deadline. Let's listen in to the latest update that he has to share.
बड़े सौहार्दपूर्ण वातावरण में बातचीत चल रही है और मैंने पहले कई बार कहा है कि कभी कोई डेडलाइन के आधार पर फ्री ट्रेड एग्रीमेंट ट्रेड नेगोशिएशन नहीं होती है। भारत के किसानों का, भारत के मछुआरों का, भारत के एमएसएमई सेक्टर का, जब तक देश हितों को पूरी तरीके से हम संभाले नहीं, तब तक कोई एग्रीमेंट किया नहीं जाता। बहुत अच्छी तरीके से बातचीत चल रही है, बातचीत जारी है।
Okay, let's get stock specific focus and talk about RBL Bank. That stock going to be in focus today because now it's official. Dubai-based Emirates NBD will acquire 60% stake in RBL Bank through a $3 billion primary infusion, marking the largest foreign direct investment in India's financial sector to date. The deal, approved by both banks' boards, will see RBL issue around 959 million new shares to Emirates NBD via preferential allotment. Anurag Joshi is joining us with all the fresh details on this. Anurag.
Emirates NBD, a leading UAE bank, is acquiring a 60% equity stake in RBL Bank. This will be via a preferential allotment of shares to Emirates NBD. Emirates NBD will be investing $3 billion into RBL Bank. That is closer to 27,000 crore rupees. This will be the biggest FDI investment in India's financial sector so far. Now, some of the key takeaways from the deal, and this was mentioned in a press conference that happened yesterday, were that the composition of directors, there are 11 directors on the board of RBL that will undergo a change. So there will be half the directors will be executive director, which includes the MD plus the Emirates NBD nominees, and half the board will be independent directors. This transaction will also involve the merger of the three branches of Emirates NBD into RBL, and this will be completed by April next year.
Thank you, Anurag, for all those details. But moving on, let's also listen to what the management had to say about the newly announced transaction with Emirates NBD.
The Emirates NBD, the second largest bank in UAE and a leading financial group in the MENAT region, will invest approximately $3 billion through a preferential issue, subject to the shareholder and the regulatory approvals, to acquire a 60% stake in RBL Bank. This will also trigger an open offer as per SEBI guidelines. Post completion, the India business of Emirates NBD will merge with RBL Bank. This infusion will take our net worth to around 42,000 crore and position us among the best capitalized banks in the country. It enables us to accelerate growth across our existing businesses, invest meaningfully in technology, brand, and distribution, and create a stronger, more diversified income streams.
Okay, so the RBL Bank is going to be one big stock to watch out for today. But other than that, big boy Reliance earnings candidate on Friday late evening. Mukesh Ambani-led Reliance Industries earnings reported strong numbers on all fronts. The consolidated net profit of over 22,000 crores for the quarter ended September rather. Strong sequential growth across retail and digital services as well. The net profit jumped 13% year-on-year, while Jio's ARPU also rose to 211. My colleague Ashesha is here to break down all the numbers of Reliance's earnings for us. Ashesha.
Well, yes, big boy Reliance Industries reported better than expected set of numbers across all parameters, and all segment contributed to the jump in revenue and profitability that we saw on a sequential basis. Consolidated revenue rose by about 5% sequentially. Retail segment reported very strong performance in the quarter gone by. Revenue for retail segment was up 8% sequentially, and EBITDA for this segment shot up nearly 7% on a sequential basis. Telecom segment also reported very strong set of numbers. Now, brokerage houses continue to remain very positive. Macquarie, they've maintained their outperform stance in the stock with a target price of 1650. They say company has reported broad-based recovery with retail growing by about 19% on a year-on-year basis. Jio is steady. OTC segment showed improved performance in the quarter gone by. ARPU for the quarter gone by stood at 211, which was slightly below what they were working with, but in line with street expectations. EBITDA margin expansion reflects operational efficiency and cost control, and they also expect the earnings trajectory to continue going forward, because of which they are projecting FY25 to 28 EPS CAGR of nearly 15%. So Macquarie outperform rating 1650 is the target price. Morgan Stanley meanwhile has also maintained its overweight stance in the stock with a target price of 1701. They say earnings beat estimates, strong results boost investor confidence and signals stock re-rating, which is likely to happen going forward, especially because of Jio listing, which is likely to happen in the first half of next year. Telecom segment performance was in line. New energy initiatives continue to remain on track, and they say solar module production ramping up and green energy powered AI data center is also in the works. So all in all, company reported better than expected set of numbers. Telecom, Jio, retail, all segments were firing on all cylinders, and brokerage houses continue to remain positive.
Period of time. And a small disclosure, this recommendation of Reliance is based on our research team recommendations. Our company, Geojit Rai, we do not have any personal investments, no financial interest, no conflict of interest, but we give advice to our clients on similar lines. instead of looking at short term, I think it is better to look at long term when it comes to large cap companies, especially one of the most valued companies like Reliance Industries. That's when you end up making a decent amount of return on your investment.
This is on the expected lines because the better set of numbers were expected. Leave aside the one-time Asian Paints stock sale profit, which was in the comparable quarter. If you leave aside that one-time income which was there in the comparable quarter, I think the numbers are pretty good. O2C numbers were definitely better numbers were expected, and they have come. Retail, there is definitely an uptick on the back of festive season as well as the GST relief, which has been given by the government.
All right, so that's about Big Boy Reliance, but lots of key earnings over the weekend and stocks to focus. Now let's talk about HDFC Bank, which posted a net profit of 11% year-on-year growth and 3% sequential growth is what it has seen, driven by strong core income and a one-time gain from the HDB Financial Services IPO as well. The net interest income that rose while provisions dropped sharply after heavy previous quarter. Asset quality that also strengthened this quarter. My colleague Ankur Mishra caught up with the management after the earnings. Here's what they had to say about the outlook going forward.
The point here, Ankur, is that we will grow in line with the system for this year, FY26, and we will be faster than the system in FY27, like what we have been talking about for the last one and a half years or so. The strategic direction that was set at that time continues to be in play, and our trajectory that we are in today shows that we are progressing towards that objective. I do not want to give one number of what that, whether it is a double digit or whatever the digit, because we don't want to give an outlook, but all we want to tell you is that there were certain strategic directives set, and we are in trajectory to get to those strategic objectives.
I want to understand about your operating expenditure front. It has increased 6.4% if I talk about this quarter. But in the second half, do you think that there will be reduction here, and where it is coming from in this quarter?
Okay. Listen, this is part of various investments that we have done over the last 3 years. And if you look at the branch addition, almost 40% of our branches that we added, 40% of the branches that we have in stock today have been added in the last 3 to 3.5 years or so. Now, we are focused on driving productivity from those branches, productivity in the form of both better customer engagement and bringing on new customers. I told you about the 1.5 million customers that were liability relationships that were added. We are at about 99 million customers or so in aggregate. So we are trying to drive that operating leverage where the top line growth outpaces the need for investments. And also I mentioned that our branches over the last 12 months grew by 450 plus and 46 branches in the quarter. So somewhat that is moderated compared to what it was in the past, but still a significant addition to branches that we are doing. So investments are ongoing, both branches, people, and technology, but at a pace which is lower than what it was in the previous period. So you're seeing a comparative number there, and as the operating leverage kicks in well, you're seeing the cost to income at about 39.5 or so.
One last question, if I can ask, regarding the margins front. Yes, there is some deterioration on QOQ front, but overall you have maintained a kind of guidance which you had given. So you think the pressure on the margin will continue in the second half as well?
See, there are two things on the margin. One is we do not know what the rate scenario will be because from various estimates, while the rates are held steady right now, the policy rates movement is an item that we will have to take it as and when it comes, right? So we can't bring that into account. But save that to the side. Apart from the policy rates, as we told you, the rates on the loans, prices, 70% of the loans are floating rate, and the prices, the 100 basis points, the price change on that has happened. And for most part, it is there by September, it is factored in. some more, whatever the full quarter impact is not there, will flow through in December or so, right? And any further policy rate change, we will have to handle it as it comes. And deposit rate, as I mentioned, as well as Shashi had alluded to, is a managed rate, and it takes almost 6 quarters to flow that through. We have changed the savings rate by almost anywhere between 50 to 75, depending on the value of those deposits, slabs that we did. And when you look at the time deposits, we have reduced that by almost 70 to 80 basis points or so. So that takes about 6 quarters to come in. A little more than a quarter has passed where it is factored in. So you are seeing in this quarter, if you look at our reported results, our cost of funds is lower by about 18 basis points, but the yield on assets were lower by about 27 basis points or so. That's what you have seen there. So yes, the cost of funds will, over a period of time, get the benefit of the rate changes that have happened. But we'll have to be patient to work that through. Again, don't look at it quarter to quarter, because that's not how we manage. There will be some quarters where it can be up, some quarters it can be down. That is function of various activities that happen and the pricing that happen to meet the customer demand and to meet the customer desires and engagement. So don't look at quarter to quarter, but on a yearly basis, yes, we do think if you look at the 12-month period, 24-month period, NIMs are expected to be stable to going up.
Okay, so that was on HDFC Bank, but it's all about banks. Remember, big private sector banks over the course of weekend they have reported a good set of numbers, and so is ICICI Bank that has joined that list, reported a healthy second quarter with margins beating expectations and best-in-class profitability metrics. The management reiterated that neither growth or profitability will be compromised. Let's go across and listen in to Ankur's conversation with the management of ICICI Bank too.
The next levers of the growth, you mentioned that retail is slow this quarter as bank would have liked. So will the mix change in the coming quarters? I want to know from you, because right now your corporate is growing better, but retail is at least lesser than the aspiration. So can we see that mix changing?
See, Ankur, I mean, for us, we really look at the cash flows, what's happening in the economy. And we are sort of a follower in that space. And our loan growth has been largely in line with what the system has been growing. And if you see even the various components of it, if business banking is an area where the economic activity is more and it is bankable and falls within our risk thresholds, it continues to grow. The retail, there was a bit of a slowdown, as you had seen. And as I talked about, given all the policy measures which both the Government of India as well as Reserve Bank of India has taken over the last couple of quarters, you are seeing some kind of. In fact, the retail book has grown quarter on quarter, even during this quarter, and a year-on-year growth is about 6.6%. As I did mention, we do expect that the second half retail growth should improve. The business banking growth continues to have a good momentum, and I do expect that to grow. Domestic corporate, I think as you are aware, domestic corporates have got enough cash and have got many other venues to access credit. We will look at opportunities wherever we are, which falls within both the risk and the pricing framework, and wherever it makes economic sense, we do it. We follow a fairly disciplined approach in our credit and look at the overall 360-degree relationships. That's a strategy that we have been pursuing for quite some time, and we will continue to remain focused on that.
Right. On the margins front, you have stood at 4.3%. Do you think this will be sustainable with a scenario where one more rate cut is widely expected?
We will see how it goes. I think NIM is likely to remain range bound with some benefits expected because of further CRR cuts and repricing of deposits. And also, there are competitive pressures, there is monetary policy, and lots of things do impact NIM trajectory. So we will see how it goes. From our perspective, we look at the overall overall profits from a relationship. So it's not only about the NIMs. We look at fees, we look at expenses, and the probable credit cost in terms of a product structure. So, to a short answer on NIM is we do expect it to be range bound, and of course, if there is a rate cut, there will be some nominal impact which will happen on the NIMs as well.
All right, so that's about ICICI Bank. But moving on, another banking counter on the list today, IndusInd Bank. That has reported a weak second quarter with shrinking margins and also elevated credit costs that it has seen in the quarter gone by. Its microfinance book that fell about 25% on a sequential basis, whereas MFI slippages, they also saw a surge during the quarter. The management is focusing on stabilizing the platform, strengthening governance and rebuilding leadership. MSME, retail and granular corporate segments, they will drive the growth. That's the word coming from the management. A 3-year strategic roadmap will be shared soon. My colleague Ankur yet again caught up with the management of IndusInd Bank. Let's also listen into what they had to say.
You have mentioned about accelerated provisioning which has been taken in this quarter on account of MFI book, but how should one look at it? Was it just a one-time measure which you have taken, or you think that in the quarters to come this will be required for other segments as well?
I think the way to look at this is, like I mentioned to you, core PPOP numbers are actually quite stable. The balance sheet itself is quite stable. And therefore, I do believe that the roadmap for us to be able to grow from here is quite strong.
Vehicle finance has been a core segment for you, in fact accounting for 29% of your book, but that has also degrown 4%. What do you think are the reasons there, or you think there is a revival which is expected there?
The numbers are muted in the last quarter, primarily because of the fact that the GST cuts needed to play out, and there was a postponement of demand. But as we look at the numbers post 22nd of September, demand has come back across most of the segments of our vehicle finance business, and we do anticipate that growth over the next couple of quarters should be reasonably strong.
Okay, so that was the word coming in from the management of IndusInd Bank as well. But on that note, we'll slip into a very short break and talk about more.
Market Café with me, Kanishka Sarkar and Snehi Shah. Lots of chatter about banks this morning. Now, RBL also reported its second quarter earnings where profit fell about 20% on a year-on-year basis, though asset quality, that seems to have improved with gross NPAs down to 2.32%. Harsh is here to explain what this Emirates NBD deal means for the bank and what next for the company.
Well, yes, the results will take a bit of a backseat where RBL is concerned, but Emirates NBD coming in is obviously a very big deal because it's a pref issue, and it's going to come in and buy 60% plus stake in RBL. With the open offer, it will be around 75%, mind you. So, if the entire open offer, which is at a 7% discount to current market price, does get subscribed, that will be the kind of stake Emirates NBD will own. But more importantly, it's also about how much, in terms of value, does Emirates NBD add to an RBL bank. It's a very, very solid promoter entity which will come in. Just in terms of numbers, Emirates NBD has over 16 times the assets that RBL has, 15 times the loan book, over 15 times the deposit book that it has, and has an 80% larger profit than what an RBL bank has done over the last 12 months. And therefore, it's substantially larger. Also, secondly, this will mean that the cost of funds for RBL bank will likely come down. How long does it take is the question, but it will likely come down. Third piece, no problems with regard to raw material. Therefore, you will have a large equity base already. RBL Bank, mind you, at 18,000 crore in terms of market cap. Another $3 billion added will mean that a much larger chunk will actually come in equity terms. And it's not at a substantial discount as well. 7% discount coming in at around 1.08 times price to book is not a very expensive transaction for Emirates NBD either. A re-rating in the bank could obviously be very, very positive for an Emirates in terms of value, and that's something that probably they will look out for. A little bit of a cleanup anticipated, maybe some new management will likely come in as well. So a lot of things to look out for, but most importantly, it will be that cost of funds number which will likely come down. Lower raw material cost for a bank will likely mean that better profitability will come through. That's broadly the take, of course, but this is a big transaction, much awaited, long known that something like this will come, but it's a very large one.
Okay, very large one. And Harsh, thanks so much for taking us through that. So yes, RBL Bank going to be in focus on the back of two triggers. One, its earnings, and of course, one, this big new investment coming in from Emirates NBD. But other than that, let's go across and listen into the word coming in. Because India is expanding massively on AI capabilities through government initiatives, a strong startup ecosystem and global partnerships. But how are market honchos like Madhu Kela and Ramesh Damani looking into the newly emerged space? Are they betting big on India's AI play? Let's go across and listen in.
We should look at companies which are really, and this is not, I'm not talking from a 12-month perspective, but maybe from a slightly longer term perspective, the companies which are really going to benefit out of this AI usage. Because that is something which we all of us are experiencing, that it is coming, right? Even in my own office, I'm experiencing that how AI is actually making us more and more efficient. So we have to look for companies which will benefit disproportionately, and they will not have to pass on the benefit immediately. So this will be one segment which I think could come out as a big winner.
You know, my feeling by interacting with promoters at AGMs or meeting them or going to analyst meet is there's a underlying optimism about business conditions in India. So I think there are lots of opportunities in India. Maybe not AI specific, though AI will of course change the world and will change America for sure. And India will have a lot of use cases for AI. But in terms of actually rolling out products for AI, we might be behind the curve.
All right, so those are the big bets on AI this Diwali. But with that, we're completely timed out in this edition of Market Cafe. Snehi and I will take your leave. But don't go anywhere. The market will take all the action forward. And before we go, wishing our viewers and their loved ones a very happy Diwali once again.